Welcome to this deep dive. Our mission today is to execute the final part of our series analyzing CapitaLand Integrated Commercial Trust.
Right, focusing exclusively on valuations, the latest corporate news, and the summary data.
Yeah, this follows directly from our previous segment, where we established the underlying financial data.
The objective of our analysis today is to impartially dissect the final metrics of the trust's valuation profile. And we will accomplish this by relying strictly on the quantitative data and the established financial mechanics presented in the source material.
Completely avoiding any qualitative assumptions.
Exactly. The focus will be relentlessly directed at the technical financial data, the specific mathematical calculations, and, well, the factual analysis of the corporate actions.
And just for you listening, we are examining an aggregation of official CapitaLand Integrated Commercial Trust disclosures, SGX net filings, and independent commercial real estate investment trust data.
All updated as of July 2026.
Right. So if you are listening to this and wondering how we actually bridge the gap between underlying financial health and market valuation, it starts with historical benchmarking. We have to look at how the market is currently pricing that data. So to initiate our analysis of the valuation profile, moving to the next slide, we will examine the historical dividend yield.
Okay.
The July 2026 data indicates that the current half-yearly trailing 12-month dividend yield stands at 4.67%.
Yeah, and to understand the significance of that 4.67% figure, we cannot view it in isolation. We have to contextualize it against the historical median.
Right, which the data provides.
Yes. The historical median, calculated over a highly specific series of 7 half-yearly observations, is established at 5.25%.
Okay, so a clear drop.
Exactly. When we observe a 58 basis point compression from the median down to the current yield, we really must unpack the statistical band surrounding that median to understand the actual valuation context.
Let me stop you there, because the statistical band is where the data becomes highly actionable. The calculated standard deviation over those same 7 half-yearly observations is exactly 0.34 percentage points.
Correct. And when we apply this 0.34 percentage point standard deviation to the established median of 5.25%, we generate a defined statistical range.
The plus or minus 1 standard deviation bound.
Right, which ranges from a lower bound of 4.88% to an upper bound of 5.56%.
Okay.
And the mathematical mechanics here are critical for the valuation analysis.
Because at the current yield of 4.67%,
It falls entirely outside the band. The metric has fallen completely outside and below the -1 standard deviation mark of 4.88%.
so we are not just looking at a slight dip below the median. We are in historically uncharted territory for this trust's yield over the observed period.
Absolutely.
This makes the 4.67% yield the absolute lowest point recorded within the entire 7-period observation series. The immediate question this raises for you is whether this indicates a failing asset or an expensive asset. But we must further contextualize this 4.67% yield by benchmarking it against current risk-free rates, to see if that high valuation is actually mathematically justified.
The exact spreads are vital here.
They are. The 10-year Singapore government securities bond yield sits at 2.43%.
Yeah, and that 2.24 percentage point spread represents the additional yield an investor demands to take on the equity and operational risk of this specific commercial real estate trust over a 10-year government bond.
Right. Subtracting the 4.00% special account rate from the 4.67% dividend yield results in a risk premium of precisely positive 2.67 percentage points, or 67 basis points.
Just 67 basis points.
Exactly.
Well, that differential of 67 basis points strictly quantifies the exact premium an investor is currently accepting to take on the equity, liquidity, and operational risks of commercial real estate over a guaranteed government-backed rate.
What else is the market pricing in to accept such a compressed return?
It strictly indicates that market participants are pricing in factors beyond the immediate yield. They are quantifying variables such as capital preservation, strict balance sheet security, and the mathematical probability of future distribution growth.
Okay, so future cash flow expectations.
That's exactly.
To complete the yield analysis and understand if this phenomenon is isolated or sector-wide, we have the current peer yield comparison.
Right, forward estimates.
Yeah, the fiscal year 2026 estimated forward yields for directly comparable peers are as follows.
Yield and price to net asset value operate in an inverse mathematical relationship within this sector. Because the market has assigned a premium multiple to the trust's net asset value, the unit price trades higher relative to its peers.
Right.
Consequently, a higher unit price, acting as the denominator in the yield calculation, forces the yield percentage lower. The 4.67% yield is the strict mathematical outcome of the market applying a premium valuation to the underlying assets.
Moving to the next slide, this sequence transitions our focus directly to those precise price-to-net asset value metrics, expanding the peer comparison.
Yes.
Based on the July 2026 data, CapitaLand Integrated Commercial Trust traded at a 1.1 Geta-X price-to-net asset value multiple against a net asset value per unit of 2.162 cents.
Right.
However, this multiple expanded further to a 1.16x price-to-net asset value based on the $2.48 closing unit price recorded on the 23rd of July 2026.
And we must benchmark that 1.16x figure against the broader market reality. The primary observation here is the statistical anomaly present in the dataset. CapitaLand Integrated Commercial Trust is the absolute only Singapore commercial real estate investment trust in this specific 8-peer group that is trading above its book value.
The only one.
Yes. These three factual inputs, jurisdictional stability, balance sheet security, and proven yield expansion, have led the market to assign a valuation that deviates completely from the sector mean.
But we really must analyze the extent of that divergence. There is a massive discrepancy between a 1.16x premium and a sector average where numerous peers are trading at deep discounts in the 0.60x to 0.70x range.
There's a wide gap.
Moving to the next slide, we now transition to the latest news and corporate actions recorded between February and April of 2026.
The recent operational data.
Yeah, beginning with the fiscal year 2025 financial results released in February 2026. The reported fiscal year 2025 distribution per unit was 11.58 cents. This represents a calculated positive 6.4% year-over-year increase.
The disparity between the 14.4% income growth and the 6.4% distribution growth is a mathematical consequence of an expanded total unit base.
Unit dilution.
Exactly.
Which brings us to the debt optimization actions executed in March 2026.
The green notes.
Yes, the trust reported the issuance of $300 million in green notes. These notes were priced at a 2.18% interest rate.
And the direct financial impact of this specific $300 million issuance at 2.18% requires calculation. By executing this refinancing action, management successfully pulled the aggregate average cost of debt down from 3.2%, which was the recorded rate as of the 31st of December 2025, to a highly competitive 2.9%. By lowering the cost of capital to 2.9%, the management team directly increases the amount of growth cash flow that can be converted into the final distribution per unit.
Proceeding to the annual general meeting updates and divestment data from April 2026, we see management actively pruning the portfolio. They listed 2 specific flagged non-core divestment targets for portfolio reconstitution.
Right. Bukit Panjang Plaza and the Kappa Spring Service Residence.
Concurrently, a critical operational watch point was raised at this AGM regarding tenant metrics. The data indicates that tenant sales growth currently stands at approximately 1%, while the rental reversion pace is operating at approximately 6.6%.
That is a significant divergence.
It is. Examining this data, we have a 5.6 percentage point gap between rental cost increases and tenant revenue growth.
And this 5.6 percentage point divergence is one of the most vital leading indicators for future portfolio stability. The mathematical sustainability of this divergence between rental reversions and tenant sales growth is constrained by the occupancy cost ratio.
Let's break down the exact mechanism of the occupancy cost ratio because this strictly dictates the threshold of tenant default.
Right. The occupancy cost ratio is calculated by dividing the tenant's gross rent by their gross sales. It quantifies exactly how much of a tenant's revenue is consumed by their physical space.
Okay.
If rent increases by 6.6% while sales only increase by 1%, the numerator is growing significantly faster than the denominator. This strictly dictates an immediate upward expansion in the occupancy cost ratio.
Let's model that out mathematically. If a tenant's baseline occupancy cost ratio is 15% and we apply a year of 6.6% rent growth against only 1% sales growth, that ratio expands to approximately 15.8%.
Exactly.
Their margins are being actively compressed.
Correct. And this expansion cannot continue indefinitely. The mathematical threshold for retail tenant viability typically breaks down when the occupancy cost ratio exceeds 18% to 20%, depending heavily on the specific retail category and their baseline gross margins.
Right.
When a tenant crosses that 18% to 20% threshold, the physical store mathematically ceases to be profitable.
So it forces a decision.
Yes. Therefore, by calculating the distance between the current average occupancy cost ratio of the portfolio and that 18% to 20% terminal threshold, we can project exactly how many annual cycles of a 5.6 percentage point gap can be absorbed before tenants are financially forced to default or vacate.
Which is a major operational risk.
Exactly. This mechanism is the underlying risk factor that could trigger a degradation in the overall portfolio occupancy metrics.
To examine exactly how strong the portfolio metrics are currently, moving to the next slide, we will synthesize the summary data, beginning with the core portfolio health metrics. The portfolio committed occupancy is detailed at 96.9%. This figure is factually categorized as exceeding the standard 95% optimal operational threshold for commercial assets.
Which is very strong.
It is. Furthermore, the tenant concentration data indicates that the top 10 tenants account for 16.0% of total revenue. The largest single tenant accounts for 4.6% of revenue.
The compilation of these specific metrics outlines the physical and revenue stability of the asset base, which directly insulates the trust against the occupancy cost ratio risks we just modeled.
Right.
A 96.9% committed occupancy confirms minimal vacancy drag on total revenue potential. It means 96.9% of the physical footprint is actively generating cash flow.
And the tenant concentration data is equally critical for risk mitigation, with the top 10 tenants at 16.0% and the largest single tenant at 4.6%. These figures sit well below the established 30% concentration risk flag.
Mathematically, this limits the downside risk of any individual tenant default. If the largest single tenant, representing 4.6% of revenue, were to completely default and vacate the premises tomorrow, 95.4% of the revenue base remains fully intact,
providing strict operational continuity.
Yes, this structural diversification protects the debt covenants and maintains a high distribution floor. This operational stability, generated by high occupancy and low concentration risk, is what has mathematically permitted the distribution per unit to scale consistently.
Which we see in the historical data.
Exactly. The data tracks a clear 3-year uptrend, moving from 10.75 cents to 10.88 cents to the current 11.58 cents over the observation period.
We will now report the precise balance sheet metrics that support this physical portfolio. The gearing ratio is currently reported at 38.5%.
Okay.
This specific figure sits inside the established 35% to 40% operational management band and well below the regulatory limits. The interest coverage ratio is reported at 3.8x, which sits securely inside the 3x to 5x operational band.
We must synthesize the exact parameters that compose this specific balance sheet strength. The 3.8x interest coverage ratio means the trust generates 3.8 times the amount of net income required to pay its current interest obligations.
That is a substantial margin of safety.
It is. It provides a massive buffer against unexpected revenue shocks or sudden interest rate spikes. This profile consists of the 2.9% aggregate average cost of debt we established earlier, with exactly 76% of total debt locked at fixed interest rates. Furthermore, the debt profile maintains a 4.0-year average maturity ladder.
The maturity ladder is vital. It means the trust does not have to refinance a massive portion of its debt in any single, potentially unfavorable interest rate environment. They have smoothed out their refinancing obligations over a 4-year horizon.
Exactly.
Additionally, precisely 90.7% of the total asset base remains unencumbered, meaning these assets are not pledged as collateral against specific secured debt facilities.
And an unencumbered asset ratio of 90.7% provides supreme financial flexibility. It means the trust can access unsecured corporate debt markets easily, or in a crisis, they have billions of dollars of free assets they could secure debt against to raise capital.
Which heavily mitigates liquidity risk.
Right. The combination of these variables allows for a precise calculation regarding interest rate sensitivity. Because 76% of the debt is fixed, only the remaining 24% of floating rate debt is exposed to benchmark rate fluctuations.
Okay, so the exposure is isolated.
Yes. Applying a 100 basis point or 1% upward interest rate shock to that specific 24% floating component translates to a precisely calculated 0.32 cent reduction in the distribution per unit.
A 0.32 cent reduction on an 11.58 cent distribution represents an impact of less than 3%. The balance sheet is structurally engineered to absorb interest rate volatility without fundamentally compromising the payout to unit holders.
Precisely.
Returning to the management efficiency metrics derived from the data, we observe a critical comparison. The 3-year distribution per unit compound annual growth rate is calculated at approximately 3.1%. However, this trails the 3-year asset under management compound annual growth rate, which is calculated at approximately 3.6%.
We must analyze this exact 50 basis point lag between asset growth and distribution growth and establish what it strictly indicates about the yield accretion of recent asset expansions.
Okay, let's break that down.
A 50 basis point negative differential between the asset under management compound annual growth rate at 3.6% And the distribution per unit compound annual growth rate at 3.1% is a direct mathematical indicator of distribution dilution relative to asset scale. It means that while the total asset base is expanding through acquisitions and capital expenditures, the net income generated by those new assets, after accounting for the increased cost of debt and the expanded unit base required to fund them, is not scaling at an equal ratio.
Right. We turn to the final summary section detailing key risks and the overseas operational data.
Okay.
We must strictly report the exact yield spread compression. The data shows a 1.75 percentage point spread between the portfolio's property yield and its aggregate cost of debt.
The analysis of this 1.75 percentage point spread requires strict categorization against operational benchmarks. This figure explicitly sits below the established 2.00 percentage point operational comfort line.
Let us detail exactly why that 2.00 percentage point line exists. The property yield represents the net operating income generated by the real estate, while the cost of debt is the absolute expense required to finance the acquisition of those assets.
When the spread between these two variables compresses to 1.75 percentage points, it strictly indicates compressed asset profitability relative to financing costs.
The margins are tightening.
Right. The trust is earning less on the buildings relative to what it pays the banks. A sub 2.00 percentage point spread mathematically restricts the trust's ability to generate excess cash flow.
Right.
Without that excess cash flow, management's ability to fund retained earnings, execute future acquisitions, or drive further distribution per unit expansion is structurally constrained.
And issuing new equity introduces another specific risk identified in the source material. A recent $750 million private placement was executed at a unit price of $2.30.
Yes.
This placement strictly excluded retail unit holders. When a trust issues new equity at a fixed price to institutional investors while excluding the retail base, it dilutes the ownership percentage and the proportional claim on future earnings for those existing retail unit holders.
That is a direct equity risk.
We also have the specific data regarding the overseas occupancy drag, which ties directly into the compressed profitability. The portfolio occupancy in Australia sits at approximately 91.8%, and the portfolio occupancy in Germany sits at approximately 91.6%.
And these figures significantly trail the 95% plus metric maintained within the domestic Singapore portfolio. With the total aggregate yield-to-debt spread compressed to 1.75 percentage points, the current financial data does not indicate adequate numerical compensation for the 91% occupancy performance and the structural risks of the overseas allocation. The international diversification is currently acting as a drag on both occupancy and optimal yield spread.
To synthesize the strict numerical reality established throughout this deep dive, CapitaLand Integrated Commercial Trust presents top-tier technical fundamentals.
It does.
The asset quality is explicitly validated by the data. These fundamentals include an 11.58-cent distribution per unit, a highly robust 3.8x interest coverage ratio, and a heavily optimized 2.9% cost of debt supported by the issuance of 2.18% green notes.
Right.
The balance sheet is mathematically engineered to withstand significant operational and interest rate volatility.
However, the critical conclusion from a valuation standpoint is that the market has thoroughly priced in this exact asset quality.
All of that strength is already accounted for.
Precisely. The superior fundamentals we have detailed are entirely reflected in the 1.16x price to net asset value premium and the compressed 4.67% yield we analyzed at the start of the deep dive. The market has bid up the unit price to perfectly align with the security of the balance sheet, leaving very little margin for error or outsized future yield compensation.
Thank you for joining this technical deep dive into the CapitaLand Integrated Commercial Trust financial deck, and please ensure you conduct your own strict numerical due diligence.